If there's one investment book that almost every serious investor, entrepreneur, billionaire, and financial expert recommends, it is The Intelligent Investor by Benjamin Graham. This isn't a flashy get-rich-quick book. It doesn't promise overnight success, it doesn't sell fake motivation, and it definitely doesn't teach gambling disguised as investing. Instead, it teaches something far more powerful: how to build long-term wealth without destroying yourself emotionally or financially. Before we begin, if you love business, entrepreneurship, investing, financial freedom, and powerful money lessons that can change your future, make sure you like this video, comment your biggest lesson below, and subscribe for more high-level business content every week. Because the ideas inside this book can literally change how you see money forever. Introduction to the book. Published in 1949, The Intelligent Investor became one of the most respected books in financial history. Its author, Benjamin Graham, is widely known as the father of value investing. Even legendary investor Warren Buffett called it, by far the best book on investing ever written. That statement alone tells you how powerful this book is. But here's what makes the book different. It is not only about stocks, it is really about human psychology, emotional control, risk management, financial discipline, patience, decision-making, long-term thinking. In reality, this book teaches principles that apply not just to investing, but also to entrepreneurship and life itself. The biggest lesson: investing is more about behavior than intelligence. One of the first powerful ideas Graham explains is this: the investor's chief problem, and even his worst enemy, is likely to be himself. That line alone is worth millions. Most people think success in investing comes from high IQ, secret strategies, expensive courses, insider information. But Graham says the real danger is emotional decision-making. People panic when markets crash. People become greedy when markets rise. People follow hype. People buy because everyone else is buying. People sell because everyone else is scared. Sound familiar? This is exactly what happens in business too. Entrepreneurs often fail not because their idea is bad, but because they lack patience. They chase trends blindly. They panic under pressure. They quit too early. They make emotional decisions. The book repeatedly reminds readers that discipline matters more than excitement. And in today's social media world, this lesson is more important than ever. Every day online, people are showing luxury cars, overnight crypto profits, millionaire in 30 days schemes, fake entrepreneurship lifestyles. Benjamin Graham would probably laugh at most of it, because real wealth is usually slow, boring, disciplined, and consistent. Mr. Market, the most famous lesson in the book. One of the greatest concepts ever created in finance comes from this book. The idea is called Mr. Market. Graham tells readers to imagine the stock market as a person named Mr. Market. Every day, Mr. Market comes to your door offering to buy or sell stocks at different prices. Some days he is optimistic and excited. Other days he is depressed and fearful. The key lesson? You do not have to follow his emotions. This is genius because Graham explains that markets behave emotionally just like humans do. Prices go up because of excitement. Prices crash because of fear. But intelligent investors stay calm. This applies directly to entrepreneurship. Imagine starting a business. 1 month sales are high. Next month things slow down. Competitors appear. Customers complain. Trends change. Many people emotionally collapse during difficult moments. But intelligent entrepreneurs understand something important. Temporary emotions should never control long-term decisions. That is one of the deepest lessons from this entire book. Investing versus speculation. Another powerful section of the book explains the difference between investing and speculation. Today, most people think they are investing when they are actually gambling. Benjamin Graham defines investing as carefully analyzing opportunities while protecting against major losses and expecting reasonable returns. Anything else is speculation. That means blindly buying hype coins, following random TikTok investment advice, chasing meme stocks. Investing based purely on emotions is not real investing. And honestly, this lesson is desperately needed today. Social media created a generation obsessed with fast money, but Graham teaches that intelligent investors focus on safety, research, long-term value, risk management. This doesn't sound exciting, but it works. And the truth is, most wealthy people became rich slowly. Even the biggest entrepreneurs in the world spent years building their success. The margin of safety principle. This may be the single most important financial principle in the entire book, the margin of safety. It simply means, always leave room for mistakes. For example, if a business is worth $100 million, an intelligent investor may only buy when the market values it much lower. Why? Because humans make mistakes. Markets make mistakes. Predictions fail. The margin of safety protects investors from disaster. This principle also applies to entrepreneurship. Smart business owners save emergency funds, avoid unnecessary debt, prepare for bad markets, build backup plans, diversify income streams. Meanwhile, reckless entrepreneurs assume everything will always go perfectly. And when problems appear, they collapse. The margin of safety is not fear, it is wisdom. The book's view on emotions and fear. One reason this book remains timeless is because human emotions never change. Technology changes, markets change, businesses change, but fear and greed stay the same. During bull markets, everyone feels like a genius. During crashes, everyone feels doomed. Graham warns readers against following crowd psychology. This is one of the hardest skills in both investing and entrepreneurship, because humans naturally seek validation from others. People feel safer doing what everyone else is doing, but true success often requires independent thinking, and that's why most people never achieve extraordinary results. They follow the crowd instead of thinking critically. If you're learning something valuable so far, pause for a second and hit the like button. Comment your favorite lesson from the book so far, and subscribe for more deep business and entrepreneurship reviews like this. The second half gets even more powerful because we'll talk about defensive versus aggressive investors, why most people fail financially, Warren Buffett's connection to the book, the timeless lessons entrepreneurs can apply today, the weaknesses of the book in modern times, final verdict and rating. Defensive versus aggressive investors. One of the smartest parts of The Intelligent Investor is how Benjamin Graham explains that not every investor should use the same strategy. He divides investors into two groups. 1. Defensive investors. These are people who want stability, avoid unnecessary risks, prefer long-term consistent growth, don't want to spend all day studying markets. This strategy fits most people. Enterprising investors. These investors are more active. They research deeply, analyze businesses, and search for undervalued opportunities. But Graham warns, if you want higher rewards, you must be willing to put in serious work. This lesson also applies to entrepreneurship. Many people want millionaire results without millionaire discipline. They want profits without patience, success without sacrifice, freedom without responsibility. But real business success demands effort, emotional control, and continuous learning. Warren Buffett and the book's legacy. One reason this book became legendary is because of its influence on Warren Buffett. Buffett studied directly under Benjamin Graham and later became one of the richest investors in history. Many of Buffett's investing principles came directly from this book. Buying undervalued companies, thinking long-term, ignoring market panic, focusing on fundamentals, staying emotionally disciplined. That alone proves the power of Graham's ideas. Because while markets evolved, human psychology stayed the same. Weaknesses of the book. Now let's be honest, although this book is incredible, it is not an easy read. Some sections feel outdated, some financial examples are old, and beginners may struggle with the technical language. This is not a fast-paced motivational book. It requires patience and focus. But honestly, that's part of its value. The book forces readers to think deeply instead of chasing entertainment, and that's rare today. Final verdict. The Intelligent Investor is not just a book about stocks. It is a book about discipline, patience, emotional intelligence, long-term thinking, risk management, financial wisdom. Its lessons apply to investors, entrepreneurs, business owners, and anyone trying to build lasting wealth. In a world obsessed with shortcuts, hype, and instant gratification, this book teaches something powerful. Real wealth is built slowly, intelligently, and consistently. That is why this book remains timeless decades later. Final rating. A must-read for anyone serious about money, business, and financial freedom. And if you made it to the end, make sure you like this video. Comment the biggest lesson you learned and subscribe for more powerful business and entrepreneurship content.